The development of futures and options markets did not begin as abstract speculation or casino-like invention. It began as an attempt to survive uncertainty in a world where time itself was the greatest risk. When I look back at the origins of derivatives, I do not see traders staring at screens. I see farmers scanning the sky, merchants counting the months until ships returned, and entire communities trying to answer one question that has haunted economies since the beginning. How can today's decisions be protected from tomorrow's unpredictability? Futures and options are not products of greed first, but of fear disciplined into contract. The earliest forms of futures trading appeared wherever production and delivery were separated by time. In ancient Mesopotamia, merchants used forward contracts to lock in prices for grain and goods yet to be delivered. These agreements were embedded in legal codes, like Hammurabi's, not because they were exotic, but because they were essential. Agriculture produced abundance in seasons not steadily. Prices fluctuated violently. A bad harvest could ruin a farmer. A sudden surplus could ruin a trader. Forward contracts redistributed this risk, stabilizing expectations, even if outcomes varied. The economic insight was simple, but profound risk could be shared, not just endured. This logic matured dramatically in medieval and early modern Europe. As trade expanded across seas and continents, uncertainty multiplied. Ships took months to arrive if they arrived at all. Weather piracy, war, and spoilage were constant threats. Merchants in cities like Venice, Genoa, and later Amsterdam began to formalize forward agreements not only for goods, but for currencies and shipping capacity. These contracts transformed commerce from gambling on fate into managing probability. What mattered was not predicting the future correctly, but surviving regardless of how it turned out. The first recognizable options contracts emerged in this same mercantile world. Options allowed merchants to pay a premium for flexibility, the right, but not the obligation to buy or sell at a future price. This was revolutionary. It separated insurance from ownership. One could protect against adverse outcomes while still benefiting from favorable ones. In essence, options monetized uncertainty itself. This innovation was so powerful that it immediately attracted suspicion. Authorities worried that speculation would detach prices from reality. Moral critics feared that profit without production would corrode virtue. These anxieties would follow derivatives for centuries. The Dutch Golden Age provided the first large-scale demonstration of both the promise and peril of derivatives. During the tulip mania of the 1630s, futures-like contracts were traded on bulbs that had not yet bloomed. Options multiplied leverage and participation. When the bubble burst, it was not the flower that mattered, but the contract. This episode etched a permanent association between derivatives and excess into financial memory. Yet history often forgets that the same instruments continued to function quietly in grain shipping and finance long after the mania faded. The scandal was not the tool, but the context. The true institutionalization of futures markets occurred in the 19th century, driven by industrialization and global trade. Nowhere was this clearer than in the United States. As railroads connected farms to distant cities, agricultural producers faced a new form of risk price. Volatility disconnected from local conditions. The Chicago Board of Trade, founded in 1848, standardized futures contracts for grain, creating transparent prices, guaranteed clearing, and enforceable delivery terms. This was not speculation for its own sake, it was infrastructure. Farmers could plan, merchants could hedge, capital could flow with greater confidence. Futures markets became the nervous system of industrial agriculture. Options markets followed a similar path, though more slowly. For decades, options existed in informal or opaque form, traded privately among institutions. Their complexity and leverage made them controversial. It was only in the 1970s, with advances in financial theory and computing, that options markets were fully standardized. The Black-Scholes model did not create options, but it provided a language that made them scalable. Risk could be priced, hedged, and transferred mathematically. What had once been artisanal contract became industrial finance. This moment marked a turning point. Futures and options expanded beyond commodities into currencies, interest rates, equities, and eventually everything measurable. Derivatives ceased to be tools for producers alone and became tools for financial institutions, managing balance sheets and returns. Risk was no longer just hedged, it was traded. This shift delivered enormous benefits: liquidity price discovery and capital efficiency, but it also introduced new fragilities. When risk is transferable, it can concentrate invisibly. When protection is cheap, exposure grows. The late 20th and early 21st centuries revealed both sides of this evolution. Derivatives stabilized markets during routine fluctuations, but amplified crises when assumptions failed. The collapse of long-term capital management in 1998 showed how sophisticated hedging could unravel under correlation. The 2008 financial crisis demonstrated how credit derivatives designed to disperse risk instead concentrated it systemically. These were not failures of mathematics alone, but of belief. Models assumed independence where behavior created linkage. History intervened once again to remind markets that uncertainty cannot be eliminated, only rearranged. Across this long arc, futures and options markets tell a consistent story. They emerge to manage risk created by scale, distance, and time. They grow as economies grow more complex. They attract speculation because speculation is inseparable from uncertainty. And they periodically provoke backlash when their power outpaces understanding. Every era repeats the same argument: are derivatives tools of stability or engines of excess? History answers with nuance. They are both depending on discipline, context, and memory. And it is here at the point where derivatives have become embedded in nearly every corner of modern finance that the story of futures and options reaches its unresolved present, because these instruments now shape not just prices, but behavior, incentives, and systemic risk itself, and understanding their history is no longer optional for anyone seeking to grasp how modern economies manage uncertainty. Gamble on expectation and attempt again and again to tame the future before it arrives, as the narrative turns toward that system. Because once derivatives become pervasive, they stop being mere contracts and begin to function as architecture. In the modern financial world, futures and options no longer sit at the edges of production. They sit at the center of decision-making. Farmers still hedge crops and airlines still hedge fuel, but now central banks watch futures curves for signals. Corporations manage earnings through options, strategies, and investors shape portfolios around implied volatility rather than physical supply and demand. Risk has become something not only managed, but observed, traded, and anticipated collectively. History shows that this shift alters behavior in subtle but profound ways. When futures markets signal abundance or scarcity months ahead, producers adjust output before reality arrives. When options prices imply calm, leverage grows quietly. When volatility spikes, fear spreads faster than facts. In this sense, derivatives compress time. They pull the future into the present and force markets to live with tomorrow's expectations today. This can stabilize planning, but it can also synchronize error. When everyone hedges the same risk, the same way protection becomes correlation. The late 20th century offered repeated warnings. Portfolio insurance strategies in the 1987 stock market crash relied on derivatives to limit losses, yet their mechanical selling amplified the fall. Long-term capital management used options and relative value trades to exploit tiny inefficiencies, assuming diversification, where stress would later erase it. Each episode followed a familiar script, sophisticated tools, rational models, and the quiet assumption that history had been tamed. Each collapse reminded markets that uncertainty clusters, not disperses when confidence is highest. The regulatory response to these episodes echoed earlier cycles. Clearinghouses were strengthened, margin requirements adjusted, transparency improved selectively. Yet derivatives proved resilient, not because they were harmless, but because they were indispensable. Modern economies cannot function at scale without instruments that bridge time and uncertainty. Futures and options are the grammar of expectation. To remove them would be to force economies back into a world where every decision is a gamble against fate rather than a calculated exposure. What changed after 2008 was not the existence of derivatives, but awareness of their systemic role. Regulators began to treat derivatives markets as infrastructure rather than side bets. Central clearing was mandated to prevent hidden webs of obligation. Stress testing assumed derivative failure scenarios. Still, history suggests humility. Risk does not disappear when regulated. It migrates. New products emerge. Old assumptions reappear in new forms. The danger is never the instrument itself, but the belief that it has made uncertainty manageable once and for all. Perhaps the most important historical lesson of futures and options markets is ethical rather than technical. Derivatives reward foresight, but they also reward asymmetry. Those closest to information liquidity and capital benefit most. When risk is priced, someone always pays less and someone pays more. This does not make derivatives unjust, but it does make them political. Who is allowed to hedge? Who bears residual risk? Who is rescued when hedges fail? These questions echo ancient debates about debt insurance and moral hazard. As technology accelerates derivatives, markets are entering another transformation. Algorithmic trading, real-time risk, analytics, and tokenized derivatives promise speed and accessibility, but they also intensify feedback loops. Decisions once made by human judgment are now executed in microseconds. History warns us that when speed outruns comprehension, stability becomes fragile. Futures and options can dampen shocks only when participants understand their limits. When used as substitutes for understanding rather than complements to it, they magnify the very risks they were designed to contain. Looking across centuries from grain contracts etched in clay to options priced by equations and machines, the continuity is striking. Futures and options exist because humans cannot wait for the future to arrive before acting. They are instruments of hope and fear disciplined into form. They allow societies to coordinate production, investment, and survival across time. But they never eliminate uncertainty. They merely decide who holds it, when, and at what cost. If this exploration of the development of futures and options markets has deepened your understanding of modern finance, I invite you to subscribe and continue these historical journeys with me, and to leave a comment, sharing which moment in derivatives history you believe best explains today's markets. Because history teaches us that the future cannot be controlled, only negotiated, and derivatives are the language through which modern economies conduct that negotiation every single day.